Good morning and welcome to Aditya Birla Sun Life Mutual Fund's annual investment outlook for 2021. Firstly, a very happy new year to all of you and wish you a prosperous 2021. Every year, this is an event we look forward to meet you all together, but given the times that we are in, we have to connect digitally. But here's hoping that we get to catch up in person very soon. The year gone by has been unprecedented in more ways than one, as the country gradually goes through the unlock process and business activity revives. It is a good time to get a sense of what lies ahead for the economy and markets, and as a result, for the investing community. To throw light on the same, we have our in-house experts who will share the investment outlook for 2021. We are joined by our MD and CEO, Mr. A. Balasubramanian, Chief Investment Officer for Fixed Income, Mr. Maneesh Dangi, and Chief Investment Officer for Equity, Mr. Mahesh Patil. Before we begin, a few points to note. This briefing is in listen-only mode. We will begin with the opening address by our MD and CEO, followed by the presentations from CIO Fixed Income and CIO Equity. The presentations and summaries have already been emailed to you. Please reach out if you are yet to receive. After the presentations, we will open for Q&A. Request you to type in your questions along with your name, organization, and who the question is for. We will try to answer as many questions possible within the planned timelines. For the rest, we can always connect again. I will now request Bala sir to make his opening address. Over to you, sir.
Thanks, Amrita. First and foremost, thanks to each one of you for taking time out to come and listen to our annual outlook presentation, which we started off almost about 8-9 years back. And we have been continuing this exercise of engaging with all of you, both to give a view on the outlook on the economy, the investment trend that's gone past and is emerging, as well as have an informal chat on various things that you may want to have. We started this exercise as part of our knowledge imparting initiatives, and therefore to add value to each one of you in whichever way we can do. At the same time, give out our fund house expectations on the economy and the investment world. Also, I want to take this opportunity to wish each one of you a very happy new year, and I'm sure 2021 is going to be more exciting, insightful year for all of us, pure on the back of the learning that all of us would have had the last 9 months post-COVID, how to work from home efficiently, at the same time bring in high level of new thoughts, the way we have been doing things. With respect to the business, the last 9 months, it is known to all of us. We all began the year with good optimism in the month of January 2020, without knowing that pandemic is going to come and hit us in the month of February. And then it carried on. The pressure went building up. But as Amrita used the word unprecedented, I'm sure all of us would have heard this word a multiple number of times, and which is of course unprecedented on both the sides. It has been unprecedented the way I think the economy got impacted, the way the lockdown got announced, knowing very well this is going to have a deep impact on the economic activities of the country. And despite that, the unprecedented move, unconventional move, which were taken by the policy makers, is equally unprecedented compared to what we were seeing in the past of similar of different kind of crisis that came and hit the world at large, and especially the financial market. And while as a fund house during the 9 months period, and given the fact that we spent about this is the current 26 years running for our Aditya Birla asset management business, started off in 1994, and been part of the various cycles that has been impacting the capital market in general, financial market in particular. And that's something we have gone through right from 1999 bubble, and then went through the whole different type of the crisis that came and hit, including the 2008 crisis. And each crisis, of course, have to be managed in a manner that we not only remain resilient in the whole the downturn, we also use our time for doing things differently and ensure that our future growth remains somewhat more sustainable and more visible. That's what we have done at the Aditya Birla Mutual Fund in the last 9 months, engaging with our distribution partners, engaging with the investors, connecting with the people like you yourself on a continuous basis without knowing, without having a clarity in terms of what could happen. But of course, at the end of the day, is all about taking intelligence call and apply the intellectual capability that we have built as a fund house in giving a reasonably good experience to the investors on the basis of our investment management capability, being driven by both Mahesh and Maneesh and the rest of the team members, have been extremely proactive during this period, which has helped in terms of delivering one of the best possible outcome, both in the fixed income fund management outcome, as well as on equity fund management outcome in the form of return to the investors. So that's something during this period worked out quite well. And second, during the same period, we could also do pretty well in terms of our engagement across the board using the virtual platform, which of course all of us have been using it very effectively. And we could reach out to more number of people, both at the distribution side as well as investor side, the multiple round of conferences, engagement activities, and that's something also has helped us in terms of keeping up our overall momentum as an asset management business, as well as in the overall size that we have. So as I speak, we now our assets and management, which had dropped as well as about 210,000 crores in the month of March, one post the fall, as well as in general, there were uncertainty in terms of how money market will function and so on and so forth. And since then, our assets and managements have grown quite substantially. Today, we have about close to 2,70,000 crores assets under management from 2,10,000 crores where we started at the beginning of the year. The same with equity assets have dropped to as close as about 68,000 crores in the month of March. I've now bounced back to about 95,000 crores as I speak. But as things kept moving, we could also engage with the people on areas which the investors do have their own what do you call the apprehension in their mind. What should I do with my investment? So we kept actually insisting on our the strategy of that mutual funds provides clearly a solution to every need of the customers, whether it is investing in liquid fund for the purpose of savings, whether it is investing in fixed income scheme for the purpose of generating income, whether it is investing in equity for the purpose of creating wealth, whether it is investing in ELS scheme for the purpose of creating a tax benefit. So that's something that remains as a core area of focus, and therefore investors should not move away from that core area of focus, fundamental purpose for which is investing in mutual fund. Second is fundamental purpose for which is investing in SIP is also something we started reiterating, clearly coming out with an idea is called everybody has got fear about investing in the market. At the same time, when there is a fear atmosphere, that is the time one can actually take a bold call of investing. That's what Maneesh and Mahesh gave a big call of investing in equity at that point of time. And that's what I think is something we kept using it continuously as part of educating the investors during the uncertain time when they have an apprehension as to what they should do with their investment. That's also something that could come in handy for us in maintaining our SIP overall book size. And that's something helped us in bringing up our overall momentum as an asset management. Therefore, we could close the December 2020 a reasonably good number, both as an overall assets under management as well as on fixed income. Probably would have touched one of the highest AUM pre-COVID level, as most of the companies have been using as part of the guidance and quarterly results. I would probably say that our growth has been much better than even the pre-COVID level in terms of size, especially in the fixed income, given the fact we have seen a significant fall in interest rates, and a proactive call coming from Maneesh and the team have also been a guiding factor for most of the investors to choose the funds that can deliver a better return. And given the fact interest rates are falling, and to as low as to 3% kind of rate that we are saying, During this period, generating ideas is also equally important to generate the extra 40-50 basis point extra return one can get in the fixed income space. The same way in the equity space, we have seen a significant drop in the small and mid cap companies between the 2018 and 2019 period. And Mahesh has been reiterating continuously that we'll probably see a broad-based rally in the market, which is what has played out quite well. Probably will continue to play out even as we move forward in bringing the broad-based participation in the equity market, given the fact where the interest rates are today, and given the fact that Government of India and RBI working very closely with each other and ensuring that our Indian growth rates come back quite smartly, much ahead of some of the other economies in the world. That I'm sure you will get to hear more in detail from both Maneesh and Mahesh on the investment outlook as we move forward. So with this, let me again, once again thank for your presence. And so I would like to wish each one of you a great year going ahead. With this, I'll now invite my other colleagues with this word to Amrita.
Thank you, sir. Thank you so much for sharing your perspective. I will now request Maneesh to share the fixed income outlook for 2021. Maneesh, over to you.
New Year wishes to all of you. So I'll quickly get into a few things that I would like to cover. So let me sort of first give you a summary of what we are thinking as of right now, and I'll try and emphasize upon areas where our views are somewhat differentiated from consensus view. One, of course, is that since the beginning of April, we've argued that the scarring due to COVID would be minimal for our economy and broadly for a world economy, and therefore there will not be any substantial and durable losses because of COVID-19 in the economy. So, in a sense, sitting in 2025, if you were to look at the output of the country of ours or US, you would be forgiven to even think that something like COVID did not happen. So that's what our expectations are. So I mean, we call it V-shaped recovery, but you could call it anything, but no big scarring. That's been our view. I think we too sort of were taken aback looking at Q1 data, but broadly we've stayed with that view, and we think that we are on our way to recover fully from COVID-19 crisis. And I would argue in a while that things would actually be better than they would have been had COVID not happened, at least for India. Our view for FY21 has been since beginning that we would be degrowing only at 5%. We actually made it a range of 5 to 6, but I personally think that our growth drawdown for FY21 will not be more than 5%. Now that's in contrast to what Street thinks, which of course, and including RBI, who all are mostly at 9% even after upward revision after having seen the Q2 data. Everyone has revised upward, but they're still at 9, and I would argue that the growth to run will not be more than 5%. On top of it, we think that next year is going to be sort of historically high level of growth that you would witness. More like 13% growth next year, and then thereafter 7-8% growth for next couple of years. So that's our broad growth outlook, and I'll try and explain as to why I think. Or rather, the reasons why perhaps these numbers would actually materialize, and why most economists and strategists are still getting this part wrong. Second part, of course, is I would argue that for rest of the decade, we would have higher than the previous decade's growth, and which was close to 6.5%, and I will argue that it's going to be somewhere between 7 to 8% with upside risk to it. So I'm actually a bit growth bullish relative to Street again. On inflation, we think that the inflation has peaked. You would see inflation cooling off almost secularly throughout the year Of course, the next number is likely to be close to 5, but my expectation of December 2021 is close to 4%. Now, that's where our view on inflation too is in contrast with what Street thinks. If you survey an economics, or I mean, about 20 odd economists that we surveyed, the big picture emerged that, economists are at close to 5.5%. We are actually about 150 basis point lower in terms of our inflation outlook for 2021. So in a sense, sort of Goldilocks for our country, supercharged growth in 2021, 22, and relatively modest inflation, so which is going to be supportive of equity as an asset class. Generally speaking, interest rates also will actually be sort of be stable. They won't be rallying. We're not penciling in any rate cuts incrementally. We think bonds don't have much to gain from here, but they are good carry assets. I mean, and we will argue as to why, if you are a 3-year money, then you should be in a 3-year asset instead of a 1-year asset or 6-month asset. So our guidance throughout 2020 was to actually move up the curve in terms of duration. So I think something similar we would argue even in 2021. So that's a big picture, quick view, and I'll take you through some of the important charts and argue as to why what we think would actually materialize. So this is on the first few charts are on why we think there's going to be V-shaped recovery. Our assessment is that in 2021 the global growth will be about 5%, and 2022 will be about 4. This is after a drawdown of near 4% in 2020. So in a sense, at least for next 2 years, which is 2021 and 22, world would actually grow somewhat faster than its potential. But given that there is a huge amount of slack in labor markets, and it is also that the growth numbers of 2021 would have very low base. We still do not think that it would lead to overheating of economies, and actually, which is why we would argue that rate hikes or such likes across the world are actually far away. In not any time in near future, we would see major central bankers across G20 would be hiking rates. The On the right side, this is an interesting chart which actually suggests that the similar ideas I presented on V-shaped recovery. The blue line actually hints at a sharp decline in the GDP, and actually quickly reversing to the pre-COVID path, which is the amber line. And basically, we think that somewhere in 2021 or 22, the growth in the world would actually return to the pre-COVID path. So that's what academically is called V-shaped recovery, where the losses are recouped fully. So by the way, post GFC, we didn't have V-shaped recovery. It was a very slow recovery. And some of the economies actually could never recoup the losses that they had after the GFC. A quick half a minute on pandemic. We all are aware that it's surging across the Western countries. Northern Hemisphere essentially is experiencing rapid rise in cases, but its impact on mobility is far lesser than what it was in March, April. People have figured out as to how to deal with it, and to that extent, I shouldn't I shouldn't exaggerate this point, but I have to admit that people still are far too focused on COVID-19 in understanding and assessing the economic recovery. Its relevance is far lesser than what was assumed in March, April, largely because the mortality rate of this virus is very low. I mean, but more specifically to South Asia and generally for Asian economies, it turned out to be fairly timid virus, and to a large extent, I would argue for India, this problem is passé. The reasons why, of course, we are experiencing V-shaped recovery. I do not want to emphasize this now, given that it's been the talk of the town for the last 10 months. There's been a breathtaking amount of fiscal support. Largely, if I were to sort of group the economies of G20, you had you had advanced economies doing about 20% of stimulus, split in fiscal and monetary terms, 50-50. The emerging market stimulus was about 6%, again 50-50. In India's case, we had slightly orthodox fiscal response. When I say orthodox, essentially means lower than what you experienced in emerging markets, and of course far lesser than developed markets. We had about 1.7, 1.8% worth of fiscal stimulus, and but we had a reasonably good monetary policy response, and below the line sort of backstop measures like measures for MSME, that actually resulted in fairly a quick healing of our economy. It's not fully healed, but it is on its way to sort of heal fairly quickly. This I've already argued. I mean, a small point on the right side, bottom right chart, effectively tells you that why equity markets and real estate across the world, actually not just in India, are super excited right now. Are getting bubbly, of course, is because the real effective interest rates across the world are very, very low. And in India's case, of course, we've got a double bonanza. We've had a super low nominal rates, and inflation has actually surged throughout 2020, and that led to a very low, I mean, or rather big negative real rates. That was the right thing to have. In fact, people don't appreciate this much, that how good the inflation's turn has been for India in a crisis year. Especially when corporates and borrowers could have struggled a lot because of the income loss. High inflation was actually panacea for most of the borrowers. So in India's case, inflation was actually a good news. But unfortunately, most of the world could not create inflation precisely for the reasons that we wouldn't anticipate, because the growth slowdown or aggregate demand destruction was substantial. I think I've already talked about it. I basically want you to focus on the right side top chart. Basically, we argue that contrary to what is many street and economists actually argue, that from 2021 onwards there will be fiscal will be a drag. I think it's sort of a mistake to think like that, because it is true, while the fiscal deficit would actually begin to come off, but because the activity were offline for entire year, therefore the revenues of the government actually took a beating for a year. But all of them will get restated fairly quickly, and which would mean that the cyclically adjusted balances would still be higher in 2021 and 22, which essentially argues that fiscal would still be stimulating growth instead of actually becoming a drag, and which is one of the reasons why we are extremely bullish on growth for not just 2021 but 2022. And we think that street is getting it wrong in actually believing that fiscal will be a drag. The other stuff on these, you can have a look at them later, but net the big point is that both monetary policy and fiscal policies would continue to reflate the world even in 2021. Now there are the big picture asset class views. We think that a dollar would weaken for a variety of reasons. One, of course, is that dollar is expensive relative to other OECD countries. If I were to look at from a PPP basis, dollar is almost 25-30% expensive, and so therefore I think dollar weakness is here to stay. For throughout couple of years. I think dollar would continue to weaken. By the way, US guys have actually weaponized dollar to a certain extent, and they want dollar to weaken to support their recovery. So I think that's another reason. Third, of course, is that dollar is a counter-cyclical currency, and if growth is going to be recovering pretty much across, including in US and emerging markets, these times typically dollar tends to weaken. So our sense basically is that you would see sustained weakness throughout 2021 as well. So something similar to what happened during 2003, 4, 5, 6, 7 could play out to dollar. Uh, we were very bullish on commodities, throughout 2020, beginning April. But now we are actually becoming somewhat neutral. Commodities have run up a lot. They're almost 50% up. CRB metal is up 50% since March. And oil too has pretty much doubled from the baseline $25-30 that it got to. I mean, I'm not taking into account the negative oil rates right now, but net, commodities have reflated a lot. And while we think that they can sort of stay here for throughout 2020, but then we're beginning to sort of turn neutral on commodities. More specifically, we think that oil is unlikely to sort of go past 55 $60. In fact, I'll share this with you later, but most probably the oil would perhaps be at these levels, 50 $60, even 10 years out, given the resurgence of or not resurgence actually, given the popularity and the tech of EVs that we are getting it right now. It's very likely that the oil would sort of stay low. That's important for India, that all of you are aware of, because we do import more than 90% of our consumption, and it's a big drag on our BOP almost always. Weak dollar generally tends to support commodities, but basically, given that they've already run up a lot, you should see even the food prices are up by good 11-12% year on year. Metals are up by 20% year on year. So my sense is that the space for metals and commodities to as such to rally significantly in 2021, I think is not much there. So that's our big picture view on commodities. Everyone, of course, on the street talks about equity being expensive, but it's the more expensive and rather fairly bubbly things in the world are actually bonds. I won't say that for India because India bonds right now, the 10-year, let's say, is trading at annualized 6%. And I won't be surprised if next 10-year inflation is somewhere between 4 to 5. And that actually means that, if you are a 10-year government bond investor in India, you would earn about 150 basis point real returns. Now, if there's something similar what to be looked at in US. US is pricing almost 2% inflation over next 10 years, through tips. And the US treasuries are trading at 1%. So if you are a US 10-year investor, you would earn minus 1%, So to contrast it with 1.5% positive returns in India, just about minus 1% in US in real terms, that's a 2.5% gap. So if the bond math or the currency math guy would know this, that all of this should mean that currency should have the tendency to appreciate, because a lot of dollar guys would rather move to India bonds. I mean, it won't happen exactly in this form, but if like to like, if the adjustments were to take place, our currency will have to rally almost secularly throughout 2021. I don't think RBI is in a mood to allow currencies to appreciate, given that a currency has become a part of our industrial policy, and I'll explain to you later how. But broadly, basically, I want to simply make this point here that the global bond valuations are quite rich, and while they will not go up because Fed, ECB, JGBs of the world will actually backstop them, but then there's no big money to be made. There is a small contra call here. I have that it's somewhere in the middle of 2021. I think US Treasury would begin to rally again, because if let's say in US's case, inflation outturn is not as much as market is expecting, I think Fed would turn easy again. So that's our big picture view on bonds. Quickly on India, we think that India drawdown, I explained to you, will be about 5-6% in 2021, FY21, and about 13% growth in FY22. The Bloomberg consensus numbers are, of course, are such that even in the end of FY22, an average economists think that our output would be close to where it was in FY20 end, which is March 20. So 2 year, we would not grow at all. In our sense, in our calculations, we would be about 6 to 7% wider than where we were in FY20. So basically, we are very, very constructive on growth, and we have been, throughout last 8-10 months. On the right side, of course, you guys are fed with so much of data. I do not want to emphasize it, but all the monthly indicators that we track are supercharged and all are hinting at super high rapid recovery, so to say. This GDP number also, we think would be most street is, somewhere between -1, -2%. RBI is about 0.5% negative for Q3. We think it'll be about 2-3% growth for the year. Um, Now I have to rush through this, but essentially one of the reason why even government, which was actually becoming a drag uh, for for Q2, that is July, August, September. For the second half, government expenditure is likely to grow at 30%. So in a sense, government too would be stimulating growth incrementally. Our fiscal response, as I said in the beginning, has been relatively weak, but actually the next 6 months you would see, the next 3-4 months actually you would see a fairly sharp fiscal support for the growth. Which is why I think both the December and the March quarter numbers would be an average 3-4% positive versus RBI's expectations of near zero or stagnant growth, so to say. Pandemic in India, I do not want to emphasize this. Everyone knows the number of cases are below 20. I think this problem is pretty much sorted. This remains, of course, a risk that I must highlight. What if it returns to India? But as of right now, it appears that in many parts of our country, the seroprevalence has gone up to a point where it is this virus has stopped raising in those areas, especially in the urban India. Activity normalization has been pretty rapid. Just about 10-12% of India, the education, some of the tourism related sectors are the ones which are offline right now, but pretty much everything else is back to sort of routine life in India, and actually activity is chugging along fairly well in India's case. In India too, the rates have been cut sharply, and I want you to sort of have a look at on the right side bottom chart as to the weighted average lending rates in India in real terms. So basically where banks lend and the inflation is the difference of that has fallen quite sharply. During 2014-19, the average, real rate used to be, let's say, 6.5%. As of right now, if I look at today's inflation, that's just 1.5%. So that tells you that, the real rate for the borrower in India actually has collapsed. And which is why I argued earlier also that most probably this will fire up housing markets and other real assets, so to say, in India, because these rates are super low, and I think will supercharge the recovery in India, even on the investment side. RBI has actually done an extraordinarily good job, and I would argue that one of the best ever that RBI that I've seen in last 20-25 years. They've sort of backstopped the system, provided huge amount of liquidity, cut rates ahead of many other emerging markets, and stayed put, not wavering because of higher tone of inflation, so to say, and being aware that some of this was simply a supply disruption. So 10 on 10 to RBI on what they've been able to achieve. And of course, if they stay put with these policies for a while, as I've argued that a supercharged recovery would actually take shape in days to come. The credit is beginning to recover. I think Mahesh would talk about it, but we are all very, very surprised. Most street is surprised that the losses because of COVID-19 to banks and financiers have been minimal. I think the credit cost for the banks and NBFCs together would not be more than 1% now that we have data and guidance from many financiers. And that essentially means that the credit would begin to pick up because the outcome was not so bad, versus what was what one would have expected a few months ago. So I think that the credit growth in retail too would start to fire up in months to come, and that would also sort of start to support the growth that I'm anticipating. Again, I think I've talked about it. The super low real rates, high level of affordability, and generally that we've seen some cuts in prices in housing market. You are seeing a very sharp recovering in housing. So the housing market has gone through a 5-6 years of bust, but I think the stage is set for a secular recovering housing market. And I think we also sort of believe that the residential real estate market would enter sort of a bull market. It won't be anything close to what we experienced during 2000, 2015, 14 rather. It would be somewhat tepid, would actually underperform equities, but would outperform, what do you call it, bonds. The fiscal deficit, which is important for bonds, last year in FY21 would be close to 11%. So we are thinking right now that while this chart suggests 6.8% is what we think that the fiscal deficit for the center would be somewhat less than 6.8 on the left chart, and it'll be about 6.5, and the state fiscal deficit will be about 4.5%, taking it to about 11% of fiscal deficit. Next year, fiscal deficit for center is likely to be 5%, and the state 3.5%, so about 8.5%. But as I said, that it would still not be a drag for the reasons that I mentioned earlier. So India's fiscal response, as I said, has been a relatively milder, but then you still had a large amount of fiscal deficit, resulting in substantial increase in the public savings, because when fiscal saves, the saving of people actually rise, and which is what we saw in the first quarter when the public saving actually had shot through the roof. So something that was experienced by US consumer or households was experienced in India as well. On the current account side, we would clock about 1.5% current account surplus FY21. But, given that last trade data suggested that the imports are starting to sort of recover fairly quickly because Indian demand is actually recovering, rest of the world demand is starting to falter a bit because of the resurgence of virus. At least in near term, we have a small threat on the export side. But net, I think that, you would see current account returning to deficit in FY22. So throughout 2021 also, I think we will run about a percentage of current account deficit. But given that the BOP is very healthy, it was about 90 odd, it'll be about 90 odd billion dollar for FY21. For the next year, which is 2021 calendar year, we are baking in about 60-65 billion dollar of BOP. So reserves will continue to go up. Where big picture assessment is that by the end of 2024, we will get to about $1 trillion of forex reserves from where we are right now. INR view of ours is that because that we are weak, we are actually thinking that the dollar would be weak. We think that the INR would continue to have appreciating bias. But given that RBI, government, all are working towards making India a manufacturing hub, it makes sense to let INR stabilize here instead of letting it appreciate, because it offers us some competitive advantage. So I won't be surprised if the INR actually stays close to where it is right now, but the general tendency in absence of RBI intervention would be appreciating INR. Inflation, I've already argued. Basically, we think that the food inflation from double-digit inflation will cool off to near zero in next 6 months' time. And core two, while the goods inflation of the core would actually surge from here, the service inflation of the core, which is about 60% of core, would actually see disinflation because supply chain on the labor side, things have improved, and which essentially means that in aggregate, inflation would be lower throughout 2021, averaging at about 4.5-5%. I am penciling in close to four quarter of inflation in December 2021. The street estimates are close to 5.5%. I've already argued for this that the small data point that in last 15 years versus 1.5% of population growth that we have had, the fruits, vegetables have actually grown at 4.5%. Even the cereals have actually grown at about 2.5-3%. So basically, we are a food surplus economy, and it's very likely that we will return to normalization of food basket, and supply chain disruption would wither and essentially would result in farm distress, low food inflation returning to the talk of the town in the bond market in the year to come. Core inflation, I've already argued that the goods inflation of core would actually surge perhaps, but then rest of the inflation would actually be actually fairly low. So basically, so this is our big picture view on growth and inflation. Now I'll sort of quickly summarize on what we think, while we can talk about it a little later, but I think that over next 10 years, because of the PLIs, low oil prices, and that there is a little bit of a change in design thinking in our government supporting the growth and especially the manufacturing, and also the upturn in the housing market that we are likely to see throughout next few years. I think the stage is set for fairly sharp sort of growth throughout the decade. And I wouldn't be surprised if we actually clock the best ever growth, in 2020, so to say. So basically, I'm extremely optimistic on growth, but because interest rates are already super low, 7-8 lakh crores of money being parked today by banks in RBI at 335. Given that our real rates are super negative right now in the short term, at least 3 months, 6 months, 1 year, 2 year assets are actually below inflation. 3-year assets are below inflation. I think the space for the monetary stimulus, of course, incrementally is not there. I think the best path for us would be to stay put with these rates for a while and allow the recovery to take some solid shape. By the end of 2021, I think we would begin to see some murmurs on unwind of monetary policy. Firstly, from a sequencing standpoint, it would begin with what do you call it, withdrawal of liquidity through MSS or SWF, but the rate hike is still more like 1.5, 2 years away from here. So basically, we are making in a little bit of a neutralish policy for 6-9 months and starting to sort of tighten on the liquidity side towards the end of 2021. So that's a big picture view. There is not much to be made in terms of capital gains in bonds. But because the ultra short terms are super low, today if you invest in a fixed deposit or liquid funds, the returns are so low that it still makes sense for you to be investing in, let's say if you are a 1-year investor, put your money in low duration funds. If you are a 2-year, 3-year investor, you should put your money in short-term funds, corporate bond fund, or banking and PSU funds. So broadly, we are guiding investors that, don't run ALM, asset liability mismatch. Don't put your money in, if you have a 5-year or 3-year bond money or fixed income money, put your money in assets, which are of the maturity of 3-year and 5-year, and earn a reasonable carry there instead of actually hoping for higher rates in a year out and actually investing there, because the curves are far too steep for you to sort of wait out for the higher rates. Curves are already pricing substantial rate hikes, which most probably would not actually play out over next 1.5 year. So the broad advice to our investors is that from an asset allocation point of view, stay constructive on equity. I think Mahesh would talk about it in detail, but purely from a fixed income vantage standpoint, equity still looks more attractive. Real estate also looks attractive for fixed income investors. try and balance it by actually not running ALM. So that's where I'll stop, and we'll take questions perhaps after Mahesh's PPT is over.
Thank you so much, Maneesh, for this insightful presentation. Yes, we will take the questions after Mahesh's presentation is done. Mahesh, it's now time for the equity outlook for 2021. Over to you.
Yeah, so thanks and welcome everyone, and wish you all a very happy new year. Manish has set the background, okay, and the context in terms of the macro outlook in the economy. So I will skip those things. But just to reflect back in terms of how the equity markets have been. So if you look back and see, I mean, somebody would have told you that you would have this kind of a pandemic where GDP growth in a quarter will be down more than 20%, and where the markets would be. I mean, nobody would have thought where we are sitting at this point in time, right? The market is up 14% as we talk today, right? From the highs before the pre-pandemic level, and 80% higher from the bottom. So it's kind of been an unprecedented move, what we're seeing in the markets, and also in terms of the V-shaped recovery as we've seen in the economy, as Maneesh talked about. So what do we see, just to, before we move on to the presentation, just to summarize in terms of our outlook. So we think that we are at a cusp of a new cycle, and in multiple ways, right? It's not just in terms of the economy, but multiple ways we think that we are in kind of a transition period at this point in time. First is from a virus, okay, to the vaccine trade, okay, which is likely to play out. So already we've seen that rollout of vaccines for mass immunization is being underway, and I think that in India also, I think in the next couple of weeks you will see virus vaccine will be made available across. So that is going to really lead to from a lockdown scenario what we had last year to reopening phase. And already we've seen that global indicators are now talking back to the pre-COVID levels. Also from a recession, which we thought about, just a couple of quarters back, we are getting back into a recovery. And economic growth not only coming back also, but we are actually, as Maneesh talked about, growth estimates could probably be higher the next couple of years than what we were looking at pre-COVID levels. So that's again a big transition. And from a market perspective, clearly, I think we're seeing a big transition trade from developed markets to emerging markets, which will play out. Last 10 decade or so, we've seen developed markets do well. I think it's time for emerging markets to catch up, and we'll talk about that. We're seeing the market breadth improving from a narrow rally, what we saw in CY 18 and CY 19 and early part of CY 20, become much more broad-based. And from large caps to mid cap could be the transition in the next couple of years. Also, in some sense, from defensives to cyclicals, as we see a cyclical recovery globally as well as domestically, and with commodities moving up, I think that's another trade which could play out. So there is a transition at multiple levels, which we'll see playing out in the coming years. And I think from an overall market perspective, it's kind of a Goldilocks scenario from macroeconomic backdrop, which is coming in place, where we are seeing interest rates are going to remain low for an extended period of time. And growth, you will see strong growth recovery in this calendar year and going forward. And that should be actually a risk on for risk on sentiments globally, which will benefit emerging markets, including India. And Indian economy is at an inflection point, as Maneesh talked about. We are looking at a growth rate of around 6 to 7%, even after things normalize. And there are various pillars for that growth, compared to what it was earlier. Earlier it was mainly driven by consumption, but we also see investments, especially with the government incentive and PLI schemes, the housing sector recovery, which is expected. And more importantly, the bank balance sheets, which were clearly impaired, both banking sector as well as the NBFC sector, those balance sheets are kind of stabilizing now, and NPAs are going to be much more manageable post the COVID crisis. and that should help to stimulate growth going forward. So all in all, what we are looking at is that despite the fact that the market valuations would look expensive at this point in time, but we are getting into a cycle where we are seeing earnings growth trajectory in the next few years, okay, would be higher than what we have seen in the last 5 years. And our belief is that it will be higher than the trend growth of around 12 to 13% what equity earnings growth have delivered in the past. And that is going to really drive the market higher from here. And in an environment where liquidity will be abundant, interest rates would remain low, you would expect the market valuations to remain on the higher end. But even if we see normalization of valuation for the next 2 to 3 years, we expect equities can still deliver, even from these levels, around 10 to 11% return over the next 3 years, which we think is a reasonably good return compared to what other asset class could offer in that time frame. And considering the fact that we are looking at a much more broad-based kind of a recovery, it will be important to really put that money across segments, large cap, multi-caps, mid and small caps, I think would all do well. So that's, in a sense, the broad summary of the outlook what we are going to present. So moving on to the presentation. So as Maneesh talked about, I think it's been an unprecedented globally. If you look at what has happened in the last 1 year, is that a huge amount of liquidity released by the central banks is unprecedented, right? Compared to the global financial crisis, okay, when it was $2.4 trillion of increase in balance sheet of the G4 central banks. This time around, it will be the tune of around $13 trillion, which is 29% of GDP. And that huge amount of liquidity is what is really driving, not only help the economy to recover, but also driving asset prices higher and money which is moving into risk asset class like equity. And also, if you look at the interest rates, are also been negative interest rates globally, which is been another kind of a stance which the global central banks have taken, that they'll keep monetary policy fairly accommodative, okay, for extended period of time. And we're seeing real rates, bonds, almost like 30% of the bonds globally are yielding negative returns at this point in time. And as a result of that, we see that the recovery, what we have seen in the market, has been the fastest, okay, since 1930, right? The recovery from the bottom in the market has been the fastest recovery what we have seen. And that has really surprised everyone. And to a large extent, I don't think investors have been able to participate in this recovery. Also, what we saw that the initial part of the recovery was driven by mainly the technology stocks, which were doing well earlier also. But I mean, that polarization in the markets, what we saw was pretty much accentuated in the first half of last calendar year. And if you look at the FANG stocks, the top 5 technology companies, they accounted for almost 22% of S&P in the market cap. But we think that trend will change, and we've already seen signs of that play out in the last few months. And the breadth of the market is starting to improve. Even S&P 500 is now starting to outperform the Dow. And that trend, I think, will continue. In India also, we have seen a strong rally from the bottom. And as I mentioned earlier, if you look at over here, in CY20, despite the concerns, despite the pandemic, we've seen the market breadth actually improve. And mid-cap and small cap on CY20 basis have actually done better than the Nifty. And while it was initially led by the defensive sectors like healthcare and IT, slowly, I think the cyclicals have started to participate in the last quarter, and we've seen auto sector, the metal sector, the capital goods sector starting to now outperform. So going forward, how does it look in 2021, 22, and 23 and beyond? So I think the virus, I think the vaccine period is now likely to play out, as Maneesh mentioned. We've seen a peaking of the now flattening of the virus curve. And in India specifically, as you would have seen, that the fatality rate is now much, much lower. And so I think there's no point talking about the virus. I think it's history. And while there is still some, UK is the only place where they have announced lockdown, but I think we should not expect any more lockdowns going forward. And with the vaccine rate playing out in this year, there's enough capacity, I think, which has been built up. And you should see immunization, I think, by the end of 2021, large part of the population will be immunized. So that, I think, clearly is something which we not worry about. Again, transitioning from the lockdown to the reopening period, I think we've already seen that now the global PMI indices are now back to pre-COVID level for most of the sectors, as it can be seen over here. And if you look at this time around, the recovery in the economy from the bottom has been the fastest, right? During the global financial crisis, it took 14 quarters, okay, to return back to the peak. This time around, it is expected that it will be probably be around 8 quarters or so. So we've seen a big V-shaped recovery, which will help for earnings growth to stabilize and recover much faster. Maneesh talked about the GDP growth rate in India. We are looking at 10% growth in next year. And after that, I think we should be somewhere around 6 to 7% growth. While Maneesh talked about we can potentially go above 7% also. And there are enablers in place. Okay, we'll talk about that. If we are able to really get the investment cycle picking up, the reforms which the government has done in the last few years, if we're able to crystallize that and bring together, then actually we can break past the 7% barrier. That's a possibility in, going forward. On the fiscal policy, Maneesh talked about, I won't talk about it much. So what we're looking at is a long period where interest rates would remain low. So I think while inflation will move up a bit, but I don't think central banks are going to really budge. I think the overall environment for monetary policy will remain accommodative. And the fiscal policy also, you'll see the fiscal stimulus. If there is a slowdown, I think you will see fiscal push coming in by the central banks. And now in US with the Biden government, Biden taking over the Senate, okay, we had the 2 poll results coming in yesterday. You could see another $1 trillion of fiscal stimulus getting pushed. So that should help recovery for global growth. Again, a big trend which we see is that US dollar, okay, which was kind of fairly strong in the last 5-6 years, is likely to weaken going forward. And we've already seen that the US dollar has broken, DXY has broken below 90. And I think that trend will continue. Again, driven by the large interest rate differential now between US dollar and the other current other rates. Also, the fact that US fiscal deficit, okay, will continue to increase. So expectations are that US dollar could weaken further. And we have seen that whenever US dollar it's a counter-cyclical currency. So whenever US dollar has weakened, we've seen the global manufacturing PMI do well. So I think that trade will clearly play out. And as a result, you will see that the rally which we have seen, which was even globally, it was a narrow rally limited to the tech stocks. I think that will become more broad-based and rotation into commodities and cyclicals would play out. And there has been a strong correlation between the DXY and the commodities, as you can see in this chart. So I think this could be a year where commodities and cyclicals could do well, and that will help to broaden the market breadth, not only globally but also in India. And another big trend, what we see going forward, a transition is from developed markets to emerging markets. I think the big money flow which moved into developed markets in the last 5 to 6 years, I think that could reverse. And one reason for that would be because of the weak dollar and strong commodity prices, you would see that being a tailwind for emerging markets. A lot of emerging markets are dependent on commodity. India is not in that category, but overall emerging markets growth should be better than developed markets going forward. Also, a weaker dollar will mean that more money moving into emerging markets. And also, if you look at the positioning for emerging markets of the global funds, it's at an all-time low, right? Compared to a 10-year or a 20-year average of around 9%, currently it's around 7.3%. So there is enough headroom for global funds to increase their weightage into emerging markets. And if you look at the underperformance also of emerging markets to developed markets is now what it was in 2003 and in 2007. So I think there is enough money which is lying around, and even if this 7.3% moves to around 9% average, which is the historical average, that means almost 350 to 400 billion dollars of money which can move into emerging markets over the next couple of years. And India normally has a share of around 8 to 10% of that. So one could expect huge amount of money moving into emerging markets. And in India, also India, in fact, last year also India received a fair chunk of the FI flows. In fact, record flows of around $22 billion in the last calendar year, when we saw actually emerging markets saw an outflow of $37 billion. So India continues to remain under favor for flows. And even currently also, if you look at India's positioning in the emerging markets indices, it's overweight, around 2%, but it is still lower than its long-term average of around 3% or so. So again, there is headroom for more money to move in. And there are talks about China weightage in emerging markets could go down because the US is putting a lot of restrictions of investing into some of the Chinese companies that could reduce the free float over there. So I think all these things really point out to very strong inflows from FIs even in this calendar year. From India perspective, we talk about the virus. Okay, it's probably no longer now issue really from India perspective. The economic indicators, if you look at across the industrial indicators, are now hitting back to the pre-COVID levels. So GST collections, if you in the month of November were at 1,15,000 crores, and they could continue to move up from here as we see the industrial activity move up. Product sector like cement, for example, and steel consumption is now coming back into growth territory. The rail freight, the cargo movement is also now back to the pre-COVID level. So I think we have now come back smartly in terms of growth, which was kind of looking iffy just around a quarter back. And what is the mainstay in this period has been that the rural consumption has been very, very strong. So even in the months of June and July, okay, when the economic growth was weak, it was the rural economy which was very resilient, and that will continue to remain strong with MSP procurement targets have increased. As Maneesh talked about, agri prices have also, global agri prices are also fairly supportive. And government continues to really support the rural economy, which is reflected in the 60% increase in the NREGS trends this year. So rural economy will continues to remain at a strong footing, and that will continue to be drive for consumption and the auto and the agri sector going forward. And as a result of that, overall economic growth, we should see a sharp recovery next year. In fact, India also contracted much more because the fiscal push from the government was not as great as what we saw in the other economy. So to that extent, the rebound in the economy will also optically will look good in FY22 for India. But I think besides that, I think there are more structural reforms, okay, which we have undertaken in the last few years. I think the benefit of that will start to flow in, and that would continue to maintain India's growth rate at a much higher pace than a lot of the other large global emerging economies. And we should expect growth to trend line to be around 6 to 7% going forward. Talking about the reform, I think what has happened is that in India in the first 5 years of this government, they assured in the major reforms, and that to some extent took its toll on its growth. And I think the government is now clear that in the next 3-4 years, they want to actually take reforms which will actually stimulate growth. So big structural reforms in terms of formalization of the economy, the GST cut, the reduction in the corporate tax rate, the direct tax reforms, all these things are done. Focus is now more on growth, more into the job creation. So we've seen the PLS scheme, which has been introduced. The agriculture sector deregulation reform is also a big one, okay, which will help creation, job creation in the agri sector. Labor reforms are also being undertaken. So all these things, I think, factors are in place, okay, for the next leg of growth, I think, which India is poised. and that could potentially take us to that around 7 to 8% growth in the next 5 years or next decade or so. Just talk about the Atmanirbhar Bharat scheme, which is kind of a big initiative. So there are various factors now which are coming in place, for this Make in India or the manufacturing sector to really pick up. So there are a lot of these pull factors like infrastructure deficit, which has not been taken care of, the labor and power reforms, the corporate tax cut. But there are push factors also from globally, because what's happening between US and China and a lot of supply chain disruptions post-COVID. Many companies globally are looking at alternatives to China, and India offers a very large market which can cater to that. And the PLI scheme announced by the government with an outlay of around 2 lakh crores, which is across 13 sectors, can really contribute. If everything works well, then estimates are that it could add another 1.5% to GDP over the next 5 to 6 years time frame. So I think this is, one has to wait and see. I think if you look at the PLI scheme, currently it's announced for a couple of sectors like mobiles, medical devices, batteries. It will probably be rolled out into automobiles sector, the pharma sector, and textiles. And I think that is something which will really stimulate the whole investment cycle. If you look at in India, GDP, except for the government spending, the private sector capex is at a larger. It's been at the lowest level in the last 6 years. So that can see an up move going forward. And we've seen a couple of large global companies, especially in the smartphone segment like Apple, Samsung, setting up manufacturing base in India. So it's not only the same, but also for import. Government is also giving incentives, for import substitution. So we've seen the tariffs on a few commodities or consumer goods being increased to really support domestic manufacturing and for import substitution. Housing sector is also going to be a big, is at an inflection point, as Maneesh talked about. If you look at the affordability levels, that is at a all-time high. Back to what it was in 2003-04. Even interest rates are now back to what it was in 2003-04, right? I remember taking a housing loan at around 7% fixed rate. Now we are somewhere around those levels. So I think the fact ingredients are in place for the housing sector to also pick up. And not necessarily the prices will go up, but the stagnation in the housing market could move up going forward. And the recent push by various state governments like Maharashtra to cut stamp duty, and recently they have cut the premiums also what needs to be paid. I think all these are factors which would yield to our up move in the housing sector. And housing sector has also gone through a big reform, right? Because after the reforms with the government did. So I think now it's much more organized, and new investors are much more comfortable booking houses under the new era regime which is there. So this can be a big leg, because housing is a large part of the gross fixed capital formation, and there are multiple linkages to housing, right? Steel, cement, it employs a huge amount of labor, so job creation can really increase if the sector really picks up. The banking sector also, I think there was a concern post-COVID that the bank NPAs will go up. There are various estimates which talk about 2 to 3% increase in the gross NPA levels. But I think now the picture is much more clearer. We are not going to see as much increase. In the last quarter, the overall banking sector, the collection efficiency reported by the banks has gone up to around 94-95%, which is very encouraging. And I think the retail sector, which was supposed to be a big stress test for the retail sector, that has come out very well. And we think a lot of large banks have also raised capital and shored up their balance sheet. So they are in a better shape now to take up the challenge to stimulate credit growth. As the credit growth picks up, the bank balance sheets are in a much stronger, at least the larger banks, to stimulate growth going forward. So that's again a big positive than compared to what the situation was a couple of years back. The overall policy environment remains accommodative, as Maneesh talked about it, so which is again going to be supportive for growth. The macro situation is also very, very conducive, as Maneesh talked about. Current account deficit, while it is gone positive, but it still remain comfortable at around 1 to 1.5% or so in that range. And I think that is very important from a macro perspective, right? So one is the micro is improving, but with the macro also stability there, that is really going to drive the capital flows into the country, both FDI and FI going forward. The currency expectation, Mahesh talked about it, I won't really talk about it. Expected to be in a narrow range. While commodity prices are likely to go up and they are inching higher, which is a slight cause of concern. But oil prices, I think, should remain fairly in the range of around 60, 65 in that range, not going above 60, because structurally the demand for oil will remain weak with alternative fuels coming up. So that bodes well for Indian macro. So we don't expect a big concern on the current account deficit. So how does that boil down in terms of earnings and valuation, right? So if you look at this quarter, last quarter, I mean, everybody is surprised by the Nifty earning, right? In fact, despite a sharp decline in GDP of around 10%, Nifty earnings were more or less flat. And this quarter, also we are expecting in the third quarter that Nifty earnings will grow at around 15 to 20% in that range. So I think earnings have clearly surprised. And the reason for that is that many companies have been able to bring down the operating costs. There's a lot of cost reduction which has been there. Efficiencies have improved. And some of these costs will come back, like travel costs, other overhead costs will come back. But companies expect that at least 15, 20 to 25% of the cost cuts, what they have incurred, they will continue. And to that extent, I think you could actually see surprise in margins in CY FY22. And that could continue to drive earnings growth going forward. And so if you look at historically in the last 5 years, the earning growth has actually tracked the GDP growth. This chart on the right-hand side, if you look at it, we think that trend will start to now normalize as operating leverage starts to kick in. Some of the cost savings which the companies have incurred, okay, which will drive better EBITDA margin. And a lot of the factors which were impediment for corporate earnings growth in the past, like the NBFC crisis, the GST, the RERA, all these, I think all these things are tending to normalize. So, and in fact, we are seeing for the first time earnings getting upgraded. So, in the last 5 years, since 2014 or 2015, we have seen that Nifty earnings were getting downgraded continuously till then. This is the first time actually we have seen in the last quarter Nifty earnings getting upgraded. And we think that we are coming into a new earnings upgrade cycle from here on. And earnings could potentially surprise positively. As I said, probably the margins, property margins could be better than what the analysts are expecting. And many companies are also actually deleveraging. And with interest costs coming down, you could see surprise to the earnings. So I think the earnings momentum in the next 3 years or 4 years, I think would clearly going to be higher than what we have seen. We think that it should be higher than the long term. Forget about what earnings growth happens in it next year, right? Because of the lower base, you would see around 35% kind of earnings growth. But even beyond that, I think the earnings CAGR could be higher than the long-term average, which is around 12% or so. And it will be driven by multiple factors. I mean, it's not going to be one or two sectors which will drive earnings growth. It will be across the board. It will be the digital economy, which is the IT, internet, and telecom sectors, which will drive that. It will also be the deep cyclicals, okay, which will drive earnings growth, metals, industrial, cement, and also the consumption sector. So it will be a broad base across the sector recovery, okay, which will drive earnings growth going forward. So another important theme which we have seen is coming out is that the big becoming bigger in this period. It already started during the demonetization and the GST phase. If you look at top 5 companies, market share has increased in that period. But I think post-COVID, you see a further acceleration of that. A lot of shift from unorganized to organized. Okay, that shift is also happening. And this big becoming across sectors, not only in the banking and financial services sector, which is much more larger, but also across the consumer spectrum. And that is one of the reasons why we are seeing that the organized sector, the Nifty earning growth has been much better than what the broader economic growth has been reflected. The valuations arguably are on the higher side, right? So that would be slight concern at this point in time. If you look at the repeat trading PE multiple, it's at record high levels. But as I said, it will be not right to look at PE multiples alone. If you look at the price to book value multiple in that context on the right-hand side chart, then it is not that expensive. It is just slightly above the long-term average. But if you look at the forward earnings and the kind of growth what we're expecting, then the Nifty earnings look to be much more reasonable. And one would argue that in an environment where low interest rates, high liquidity, the multiples would remain slightly higher than the long-term averages. So you would not get markets expect to be really cheap in this kind of environment where the macros are so supportive. And market corrections, I think, will also be walked into. So we don't expect very large correction. I think any correction in the market would really be an entry point for investors to be able to come in and buy. Again, interestingly, if you look at the mid and small cap sector, which has underperformed in the last 2.5 years, is only starting to come up. We think that this, as the breadth improves, as the domestic economy improves, we see there is a good correlation between how the mid caps and small cap perform in correlation with the GDP growth. So whenever domestic growth is strong, the mid and small cap sector tends to outperform because a lot of the earnings for the mid and small cap are dependent on domestic growth. And with our view of domestic growth recovering, I think the mid and small cap segment should do well in the coming years. So I think just to summarize in terms of view on the market, I would say that clearly we are getting into a phase where earnings recovery is going to be much stronger than what we have seen in the past 4-5 years. And the outlook on most of the sectors is turning positive now. It's domestic cyclicals and financials can play out in 2021, okay, which were quite depressed in the last year. So that will provide more legs for the earnings growth to pan out. Continuous earnings upgrade cycle, I think economic growth outlook or growth forecast also, as Maneesh talked about, we are much higher than what the economists are expecting. So you could see an upgrade to that. And in an environment where low interest rates, high liquidity, valuations will remain higher. So when we look at the earnings growth and the valuations and look forward, we believe that equities can deliver around 10 to 12% CAGR over the next 3 years. Within that, mid cap and small caps can typically do better than the large caps. And overall, the breadth would improve, which will provide opportunities for active fund managers to generate alpha, right? So last 2 years, we've seen that the active fund managers have underperformed the benchmark. I think there is a case to believe that they could outperform the benchmark. And to that extent, the returns from mutual funds could be a couple of percentage higher than the broader market, what we are looking at. So this kind of environment, I think, where we are seeing equity markets, economic recovery, I think for investors, I think should continue with the SIPs. Any dips in the market should be bought into, and lump sum investments can probably be spread out because the markets are, in a very short-term perspective, look to be fairly priced. In terms of the broader themes, which we are positive on, is we continue to be positive on the consumption, especially these small ticket consumer discretionary segment, low ticket, which includes auto ancillaries, consumer durable, home improvement segment. I think should see again a big improvement as the real estate sector picks up. That's a sector which, again, where the penetration levels are also still low, it remains a structural sector for us to be positive on. Banking and financial also, we've again positive on the sector after a kind of underperformance what we saw last year. Again, there's a lot of consolidation which has happened in the banking sector now amongst the larger banks, and they will continue to do well. Corporate banks should also see stabilization or normalization in terms of the NPL scenario. And the insurance sector also looks promising with low penetration levels, and post-COVID, I think there will be increased emphasis on insurance. Among the cyclicals, the industrial and the capital goods sectors could look interesting as some of the push on domestic manufacturing picks up, and that could be another sector which has underperformed when the last could come up. And digital and theme, I think it is the most structural. I think post the pandemic, there is increased focus on digital spends, and that should help IT companies do well. In fact, for the IT companies, after a long time, we're seeing their growth rate now coming back into double digits. So that's the broad themes which we're talking about. And in terms of the risks, okay, which looking at, I think on the global front, I think there could be, as Maneesh talked about, there could be some increase in the, in policy rates will remain benign, but the 10-year bond prices could actually move up a bit. It's now crossed 1%. So that could lead to some amount of volatility. If there are higher taxes, okay, the Biden administration is the increase, that could lead to some volatility, but don't see that really depressing the markets big time. Virus, I think, is now behind. I think the vaccine is already underway, so I think that should not be a major concern. On the domestic front, I think if the overall government push, okay, is fiscal stimulus is not as big as what we're expecting. Okay, that could mean that the recovery could be slightly slower. Again, while the banking outlook and the NPL concerns are easing off, but the proof of that will only come in this fourth quarter, right? Because after the moratorium and the 90-day grace period, you will get a true picture only in the fourth quarter. So if at all there is a spike in NPLs on the retail NPLs, I think that could probably slow down the credit growth. So these are potential risks which one needs to factor in. So that's the broader outlook. In terms of asset allocation, I would say that within equities, we would say that a large allocation should be made towards a multi-cap fund, considering the fact that we are seeing a broader base value, mid-cap, small-cap, large caps, everything should do well. Then into large caps, and then some allocation into mid and small cap space. Within the thematics, as I said, banking and financials and the digital IT theme looks good. And a lot of investors are at this point in time are wary about entering into the market at these levels because of the high market valuations. So for those investors, I think a balanced advantage fund or an asset allocated fund makes a lot of sense, because where fixed income rates are at such low at 5% or so, I think if somebody wants to really move into equities with low volatility, then there is a good merit to look at the balanced advantage fund and the multi-allocator fund at this point in time. So overall, I think I would say that across asset class, if you look at gold, gold has done very well in the last couple of years. Gold outlook on gold also remains fairly constructive. Okay, the returns are not likely to be that great. We expect around 5 to 10% returns, but environment where we're expecting lower interest rate negative really, I think gold prices should remain fairly steady. So one can continue to invest into gold as an asset allocation. Real estate outlook is improving, but we don't expect only a gradual recovery in prices over there, while the overall activity in real estate sector will pick up. But in terms of as an investment, I think probably it might still not really be that lucrative. Debt, as Maneesh mentioned, the returns interest rate will remain depressed. So equity in that context, okay, around 10, 11, 10 to 12% kind of a return, what we expect will still be fairly attractive. And as I mentioned earlier, mutual funds have a potential to outperform the benchmark going forward, and they could deliver 1 or 2% higher returns. So clearly, even at these levels, I think there is a case to have a slightly higher allocation to equity compared to one's normal target allocation. And that's what we are also doing in our asset allocator fund at this point in time. So another way for investors to really participate across multiple asset classes, because we've seen the huge amount of volatility across asset classes. And what is happening is that asset classes or market cycles are also becoming very, very unpredictable. The market cycles are becoming much more shorter than what used to be earlier. And in this environment, I think for a very retail investor, it makes sense to really come through an asset allocator fund. In Birla, we have this multi-asset allocation fund. We invest into equity, within equity, domestic equity and international equity, debt, gold, We'll also have commodities coming in over here. So this uh, probably can be a way for a lot of retail investors to come in and to really play across asset classes and to reduce the volatility and earn reasonable return. This is a category, okay, which we think will really catch up going forward, and we are also as a fund house trying to really provide thought leadership in this segment, and we have one product and we'll have one more product coming in possibly in this segment. So I think that's it. I think from us, I think we can now throw open the floor for Q&A.
Thank you so much, Mahesh, for your perspective on what lies ahead for the equity markets and your sectoral views. We can now open this for Q&A. We already have received some questions. I would request the rest of you, if you have questions, please type them on the Q&A section with your name, organization, and also who the question is for. All right. Okay, so the first question, Mahesh, the first question is for you. This is from Deepthi from Cogensis. Uh, do you have a target in mind for Nifty 50 for 2021? And are there any factors that could limit the gains in the coming months?
So we don't have a target for Nifty for next 1 year because it's very difficult to really build that. As I said, we've given a target for Nifty over the next 3 years, right? Where we said that potentially Nifty returns could be around 10 to 12% in that range. Again, this is looking at what kind of earnings growth you are looking at over the next in that time frame and where the market valuations are. In the near term, though, I would say that the market valuations market is fairly priced over here. Or if you look at the current earnings, it looks slightly overpriced. But again, that should be overlooked because the earnings are depressed. So from a very, very near term, it will be more driven by the liquidity and the capital flows, okay, which will continue to drive the market. And the risk for market also will be actually the capital flow, right? So any, as you know, that if you look at the money flow into the markets, it's been mainly driven by the FI money, right? Even in the last year. Domestic inflows into equities have been fairly muted, in fact, negative. But again, that's only one part of the picture because quite some money would be coming in directly into the market. So I would not say that the domestic investors are actually pulling out money on a net basis. But clearly that is been driven by FI flow. So any change in FI flow or sentiment in a short term though can put a potential risk okay, to the Nifty from a near term perspective. Apart from that, I think I think we've seen the opening up trade play out and the recovery is strong. There could be some hiccups to that. Okay, there could be some pent up demand. Okay, which could show the numbers to be higher. You could see some moderation in growth in the next few months, and market would start to believe that probably there is some concern. But we think those are only minor hiccups. Okay, to the recovery. Okay, what we are anticipating over there. So those could be some of the factors, okay, which can probably lead to some volatility or correction in the Nifty from a near-term perspective.
Thank you, Mahesh. The next question is for Maneesh from Rahul Satija of Bloomberg. Why we haven't seen yields and spreads on AA plus and AA rated corporate bonds compress to pre-COVID levels so far? When do you broadly expect them to tighten back to pre-COVID levels, mid calendar year 2021 or end of 2021? Finally, what are the other key trends in the corporate bond market you're watching out for?
So the spreads actually have narrowed dramatically. Of course, it will take some time to get there to pre-COVID level, I guess, because that's in the corporate bond market because of the risk aversion amongst fund managers. But I'll give you an example. Let's say 2-year Chola would trade at about 540 today, and just after the crisis, it would have risen to 10% plus in May. So it's sort of, you see the magnitude of rally that you had, almost about 4.5% rally. Some of the gold financiers, AA plus firms would have risen to, let's say, 11 half, 12 in May, and they are at actually 6.5% right now. So they have rallied a lot, but you're right that you still have some dislocation, but that's sort of part of a normalization. The nominal yields are super low. There's bit of a risk aversion across fund managers. The NBFCs, which is what dominates the AA plus space, people have been fund managers have been unwinding because of regulatory constraints, and which is why some dislocation is there. But let's say a AA consumer discretionary firm would actually borrow money at 6 quarter today, uh, which is very low actually. And yes, it is true that if you compare this with NABARD 2 year 3 year papers at 4 quarter, relative to where it was in 2019, it is higher. Just after the ILFS crisis actually started to move up. But so okay. So by when it would subside, I guess over 6-12 months it would continue to rally. And my assessment is that something what played out during 2003-4 and 2010-11 would play out over next 12 months, so that if effectively the AA plus spreads would actually go below the median levels over next 1 year. So that's how I'm thinking of spreads right now. What was the second?
What are the other key trends in the corporate bond market you are watching
Yeah,
out?
so corporate bonds are actually, today the 210 spreads, 310 spreads are very high. Your 10-year NABARD, let's say it's at 6.5, and twos at 4, or below 4 rather, 380, 390. So almost 170 basis point, so 250 basis point odd sort of steepness is still there. So in a sense, since 2005, 6, 7, this kind of steepness, we've not seen. Last 10-year average 210 spread has been more like 50, 60 basis point. So the true dislocation right now is actually is in the 210s, both in government bond curves as well as corporate bond curves. And that's I mean, that's not just for corporate bond. I think for the government bond as well, because people are fearing that these nominal rates which are there right now in India are about 1 to 2 standard deviation away from median levels. We are actually running a negative real rates. The absolute rally has been phenomenal since 2018. So which is why the long ends are still high. And there's no way out because the curves are steep across the world. Everyone is sort of are fearful that what will happen when this big experiment of big monetary backstop stops at some point in time, and which is why spreads have been elevated. When would they begin to climb down? I think they would begin to climb down by when there is a lift off. In a sense, the short end actually begins to go up actually. So the long ends won't rally meaningfully, I would say. They would continue to give you good carry, but they won't rally meaningfully. The spreads will narrow by bear flattening, so to say. So 2 year, 3 year has to go up because they are right now 2 year, 3 year bonds are actually anchored with the reverse repo rate right now. At some point in time in 2022, they will be anchored to repo rate, which is 65 basis point wider than reverse repo. And so that dislocation of excess spread, would disappear once the anchoring begins to happen through repo. But that's still about a year out.
Thanks, Maneesh. Mahesh, the next question is for you from Ajay of Cogensis. He writes, with a high global liquidity and weakness in the US dollar, do you see the participation from FIIs continuing for the better part of this year? Will we see some participation from retail investors as well?
Yeah, so I think, as I mentioned, the reasons for FIC, if you look at in India, as I showed earlier, even last year, okay, when there was quite a few, almost $38 billion of outflow from emerging markets, we received around $20 billion of inflow. So India continues to find favor. I mean, despite all the challenges we might talk about sitting over here, but global investors continue to like India because they see a lot of structural stories in India from a long-term growth perspective. And now, so last year, actually, emerging market outflows, there were still outflows. This year, we are expecting that emerging markets should see a sizable inflows. Again, we've already seen that starting in the month of December, okay, that trend. And the fact that US dollar weakening emerging global macro situations remaining fairly benign, commodities being fairly reasonable. So all these are positives for flows into emerging markets. And based on the estimates, what we talked about, that how the global funds are talking about, how they are positioned on emerging markets. So there, they are compared to the long-term average. Okay, they are almost like 3% underweight emerging markets, and this has happened over the last 4-5 years. And that underweight, if it gets corrected or normalized in the next 2-3 years, that could mean around close to $350 billion of inflows, which could come into emerging markets over the next couple of years. And India's share is typically around 10% of that. So you could receive, as I said, those kind of inflows into FI flows into our markets. Apart from that, I think we've seen that whenever there is a large issuance of money, okay, which is there, and recently we saw when all these large banks raise money, there's appetite from that, not only from the ETFs and this thing, but a lot of sovereign wealth funds and other funds which participate in that. So that would also continue to flow in besides the passive flow, okay, which is coming in from the ETFs. So I think that hopefully that outlook should remain. There could be some hiccups depending on how the global risk appetite changes. If there is spike in yields globally, you could see a short-term reversal of that. But structurally, I think it should move in that direction. On domestic flows, again, it's a question about money moving into mutual funds and participation of investors into direct equity. We've seen that the participation in direct equity has gone up significantly. The trade volumes of a lot of these retail brokers has surged by almost 80 to 100% compared to last year currently. A lot of retail investors are possibly entering in the market directly. But I would guess that on mutual fund flows, I think what has happened is that after the sharp drop in the markets in the last year, the returns were not that great. And as the returns, or one or 2 or 3 year returns are starting to become more reasonable, we are seeing investors pulling out money. But as the market rally sustains here and the outlook on the economy, because people are seeing a dichotomy between the market where it is and the ground reality. As that starts to kind of bridge that gap, the economy growth and the outlook also starts to now, as it's improving, start to do that. Then you will see retail money also coming back, or investors coming back into the mutual fund. Because if you look at the alternatives, are very, very limited at this point in time. Right? Where do you put your money saving, right? In bank deposit savings bank, there's hardly 3%, less than 3% rate. Even the fixed income would give you around 5-6%, not more than that. Real estate is picking up a bit, but it's still not likely to really see investment demand over there. It's more about actual consumption demand, because prices are not going to go up too much. So the alternative is to really move towards equities only, and in an environment where your real rates are negative, right, with inflation where it is, I think the only hope to really put and to really as a hedge against inflation and to increase the value of your savings, it's only through equities. So I think that should start to slowly. I think this year we should start some again inflows coming back into mutual fund. That's what one would hope.
Thanks, Mahesh. There is a question from Suresh Anger from Hindu Business Line. Most countries are restricting imports. How will this impact Indian corporates? And he is also looking for another confirmation, Mahesh, from something you said. Mahesh said that $400 to 500 billion inflow is expected in EM due to weak dollar and excess liquidity. Is this correct? When do you expect this inflow happening?
So I talked about that, right? We talked about $350 billion actually, yeah. And this is again a clear normalization underweight, which global funds have on emerging markets. Okay, just normalization of that could be around 350 is what the estimate is. I mean, it could be higher also, but that's what, and this can be over a period of next 2 years. And about most countries restricting imports, yeah, I mean, it's more to do with, again, what to some extent, China is facing a lot of bracket, a lot of European countries. Earlier it was US and China, but now the European countries also found out that during the COVID crisis, they can't really depend on China for their supply chain. And while there is some restriction, protectionism is there across the world to protect domestic industries, but I think at the same time, there is a shift from what they were sourcing from other, like China, for example, okay, as a supply chain. I think they are looking at alternatives. And we've seen that in the chemical sector, in the textile sector, in pharma intermediaries also. And that will continue to, I think, benefit Indian companies because even if small shift happens, okay, out of China, it can be significant because India is still not a large part, especially in these supply chains, right? Especially for chemicals and pharmaceuticals, API. It's still a small portion, large portion is still imported from China. That should help to compensate while overall imports in some of these companies might not go up, but market share gains for Indian companies who are competitive and are price competitive and also up into the quality curve, they should be able to take advantage of that.
Thanks, Mahesh. Balasar, Suresh has a question for you. He says, where do you see mutual fund AUM by the end of this year and growth for Birla Mutual Fund?
I think for us, our endeavor has been to expand the market, both in customer base as well as assets under management. Currently, we have reached a level of about 270,000 crores. It's the running number. It's about 95,000 crores of equity assets under management. And being the top 5 player, I think we'll continue to work towards both in expanding our AUM as well as expanding our customer base. See, some of the vision that we have as a fund house that we need to be in terms of adding more customer base. We have a target of about 1 crore customer base. With respect to the SIPs, we are the third best in terms of SIP flows per month, which is close to about 850 crores kind of flows every month that we get. And the idea is to take this number to 1,000 crores plus per month in SIPs. And a new customer addition, generally we have about the peak that we had about 18 lakh new customer addition that we did in 2018, 2019. And that's been one of our endeavor to add new customers to our portfolios, more or less in the range of about 1.5 million customers per annum. These are some of the goals that we have. And with that goal, we also have a goal of having presence in all 543 constituency, parliament constituency location as part of our branch setup. We are already operating out of 320 locations. Our dream to have the presence in all the 543 locations for building our business. So that's the way very difficult to put an exact number. But the way we see, Suresh, is we want to be, given the fact that 26 years of sustainable service that we have been doing for the large pool of saving public in India, and given the strong brand coming from both Aditya Birla Group and Sun Life, and given the way both Maneesh and Mahesh and the entire team have been giving the best experience to investors, we would continue to be a large player as we move forward, as we have seen in the past. Yeah, what do you want to cover? Anything specific?
Sir, the first part of Suresh's question on the mutual fund industry AUM by the end of this year that you see.
Yeah. No, currently the industry size is about 30 lakh crore. Given the fact the liquidity in the system continues to remain strong, and also given the fact that the TINA factor is playing a bigger role, there is no alternate investment that's available for whether it is individual investors or corporate investors. We'll probably see the end of the year, which is, I'm talking about March 2021, which is about 30 lakh crore, probably would be about 32 lakh crores. And I would assume the next year, which is close to about 11 lakh crore, which is about equity assets and management. In all probability, we'll see a good addition, good net inflows coming in next year. I'm talking about the current calendar year. We'll probably see the equity flows going up quite significantly for the same reason which Mahesh and Maneesh mentioned about. TINA factor will continue to play a bigger role in terms of getting flows in equity, both for the mutual fund as well as for Aditya Birla Sun Life AMC. The number could be, including the mark-to-market action. Probably I'll not be surprised if it reaches a level of about 14 lakh crore by end of the current calendar year.
All right. Thank you so much, sir. Maneesh, there's a question for you. This is from Bhargav. Being fund managers, you have a longer term view. I want to know from Maneesh, what's your GDP growth outlook for the next 3 financial years?
So I did talk about the next year, which is 13%, and then thereafter 7 to 8% is not just next 3 years, but I guess throughout the decade, I think we would experience somewhere between 7 to 8% growth. Just to give you a context, over last 5, 10, 20, 25 years, we've broadly grown at 6.5% plus, 6.5 to 7. And for a variety of things that, throughout this presentation that reforms that have been undertaken by the government, the PLI schemes, of course, the new cycle emerging in housing sectors, which would mean a large amount of investment being poured in housing again in India over the next 5, 10 years. And plus, of course, the big oil saving that we are likely to have. All of that should result in about a percentage extra growth, I would say, versus last 5 to 25 years averages. And which is why I wouldn't be surprised if we throughout post 2021, and remember that 2021 13% is actually a little bit statistical one, because it's actually on the base of very low growth this year, rather contraction. But the normalized growth thereafter would be more like somewhere between 7 to 8%, I would say, throughout next decade, including the next 3 years.
Thanks, Manish. Mahesh, this is a question from Shweta Sunil from Bloomberg. What could go wrong for the Indian stock market going forward? What is the most bearish scenario you can see?
So I think many things can go wrong. I mean, we don't know. I think most of the time the risk comes from the unknown. I think it is the biggest risk which is there, which came out last year, right? But a month back, I would have said that the virus could be a second wave, could be the risk. But I think that is no longer a concern at this point in time, because it's not going to really, Manish also talked about. Apart from that, I think on the global front, if at all, I think you see some change in terms of the 10-year US bond spikes up a bit. Okay, though policy environment will remain fairly benign. That could lead to some kind of a risk off, but only on a temporary basis, because I think as long as the growth outlook is fairly good, that should not matter to global equities and risk appetite. So, but yeah, that could do. Looking at the fact that the markets have rallied so much in the last, not only in the last 6 to 9 months, but also in the last couple of months, okay, there could be some cool down because of that. Again, in terms of the US, the policies, if there are some kind of a tax increases, okay, which the Biden administration, okay, if they do on the corporates, that could lead to hurt some sentiments, okay, from a market perspective. Though I think fiscal stimulus is where I think the money will move in, so that should not really matter in terms of the broader growth. So yeah, that could be one reason for the markets to correct. On the domestic front, I don't know. I mean, the recovery, while it's looking good, if at all we see that, the pent-up demand, okay, which is there, okay, there is some easing of some numbers in a few sectors like automobile or things. Okay, that could lead to people giving some concern whether the growth recovery would indeed come back. Okay, just a concern that could cause some correction, okay, into the market, I would say. And yeah, I think that's the thing. On the fiscal side, I think maybe the budget is one. I think there is some hope on the budget that they would provide some more stimulus for growth this time around, right? Up till now, the government was slightly more apprehensive on spending on the supply side. Okay, they were trying to do something on the demand side incentives, but on the supply side, I think they should start to give incentives to stimulate that growth and not really going for a tighter fiscal policy. So, if at all they choose to go for a tighter fiscal, then yeah, could be a bit negative, I would say. So those are the, I think, concerns I would say. In terms of the worst case scenario, very difficult to predict any worst case scenario. But I think in the current context, okay, what we are looking at, I would say a market correction, I think of around say 10-15%, not a worst case scenario, but a more realistic scenario is something what I think one should can expect. I think I don't see any larger correction than that.
Thank you, Mahesh. I think with that, we have wrapped up the questions that we had received. If there are any more questions, you can always connect with us. We would be happy to answer them. And thank you so much to all our speakers, and thank you to our attendees for being a part of this briefing. Wish you all again a wonderful new year. Take care and stay safe. Thanks for joining. Thank you.